Good morning. It is Friday, June 5th, 2026. This is your Deep Dive Daily Briefing. I am your anchor, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. We begin our broadcast on the world stage, where the total collapse of the Doha framework has escalated into an unprecedented regional conflict, drawing a direct and severe military intervention from the United States. Following Wednesday's devastating missile strikes on America's Fifth Fleet headquarters and Kuwait International Airport, United States naval and air forces launched a continuous 48-hour campaign, named Operation Desert Sentinel, striking over 140 military assets inside Iran. Pentagon spokesman confirmed that the heavy bombardment targeted sophisticated air defense networks, subterranean drone storage hubs, and primary coastal missile installations along the Persian Gulf. President Donald Trump, addressing the nation from the Oval Office, declared that the era of strategic patience with Tehran has formally ended, asserting that the United States military will maintain its offensive operations until the Strait of Hormuz is permanently stripped of hostile state actors. In response, Iran's Supreme National Security Council issued an emergency decree declaring all Western commercial vessels legitimate military targets, transforming the Middle East theater into a zone of total maritime combat.
Transitioning from the kinetic theaters of war to the broader global economy, this unmanaged escalation has triggered a profound supply-side shock, forcing international economic institutions to enter uncharted territory. The Organization for Economic Cooperation and Development, issuing a joint assessment with the World Bank, has suspended its previous 2026 global growth forecasts, warning that the immediate loss of Persian Gulf oil shipments represents a structural drag that could shave up to 1.5 percentage points off world gross domestic product by the end of the year. The primary economic vulnerability is no longer consumer sentiment, but a systemic shutdown of basic manufacturing activity across Europe and East Asia. Industrial hubs are reporting a critical exhaustion of energy-derived naphtha and fundamental chemical components, forcing industrial giants to implement mandatory rolling factory closures. Economists observe that this systemic resource deficit is feeding a severe stagflationary spiral, where a rapid contraction in industrial output is occurring alongside double-digit energy inflation across the Eurozone.
In the realm of finance, this severe macroeconomic disruption has shattered traditional capital market structures, triggering an aggressive, multi-billion-dollar flight to safety and a profound restructuring of international reserve strategies. World crude benchmarks experienced an historic surge, with Brent crude testing levels above $124 per barrel as institutional investors rushed to price in a total and protracted blockade of the world's most vital energy bottleneck. On Wall Street, equity indices suffered their worst single-day rout in 3 years, as bond managers reacted aggressively to a dramatic spike in the benchmark 10-year Treasury yield, which settled near 4.65% amid fears of unanchored inflation expectations. This capital market panic coincides with a monumental migration away from traditional Western debt instruments, heavily verifying the European Central Bank's latest findings that forces of global fragmentation are compelling international asset managers to redirect their long-term portfolios toward euro-denominated debt and physical gold assets to insulate their corporate balances from a weaponized dollar ecosystem.
Turning our attention to the technology sector, the worsening physical energy shocks and credit market volatility are forcing the world's largest cloud computing providers to completely re-engineer their computational growth strategies. Hyperscalers are confronting a critical infrastructure ultimatum, as the unrelenting expansion of generative artificial intelligence workloads collides with overextended and highly vulnerable public utility grids. In a strategic corporate realignment reported this morning, technology giants have frozen planned expansions of data center clusters in traditional European hubs, redirecting tens of billions of dollars in capital expenditure toward localized, self-sustaining modular nuclear reactors on the United States East Coast. This historic pivot highlights a new operational reality where digital leadership is no longer determined by algorithmic sophistication, but by the physical, geographical security of vertically integrated baseload power systems capable of sustaining high-density computing superpods entirely independent of global commodity markets.
Finally, we look at the logistics and global supply chain networks that serve as the vital arteries of international commerce, which are now absorbing the permanent structural adjustments of a capacity-constrained global trading system. Maritime data confirms that the global container fleet is operating at an absolute maximum deployment baseline, with available idle capacity hovering at a record low of 0.3%. Shipping lines have entirely finalized their schedules for the third quarter, confirming that the Cape of Good Hope route has transitioned from an emergency detour into the permanent baseline for all Asia to Europe trade lanes. Logistics professionals report that this extended routing has completely exhausted global fleet supply, driving maritime transport insurance premiums to prohibitive levels and permanently altering corporate inventory structures. Shippers have accepted a permanent cost premium, entirely abandoning the low-cost, just-in-time logistics frameworks of the previous decade in favor of high-cost regional resilience networks to insulate world trade from state-level maritime chokepoint interventions.
In summary, the global landscape is defined by the launch of Operation Desert Sentinel as the United States executes massive airstrikes across Iran, occurring just as the OECD suspends global growth forecasts due to an acute manufacturing input deficit. Financial markets are adjusting to a historic surge in crude prices above $124 alongside severe Wall Street liquidations, while the technology sector pivots toward self-sustaining nuclear power for AI infrastructure, and the global logistics industry finalizes its transition to a high-cost, capacity-constrained maritime baseline. Based on the current data, I predict that the execution of Operation Desert Sentinel will guarantee that high structural inflation and elevated interest rates remain permanently locked into the global economy for the remainder of 2026. By choosing to launch a full-scale air campaign against Iranian military installations, Washington has effectively acknowledged that the Strait of Hormuz cannot be rapidly reopened via diplomacy. The physical process of clearing hundreds of unmapped sea mines under active combat conditions means that maritime insurance premiums and freight rates will remain at historic highs through the winter. Consequently, the severe deficit in industrial raw materials like naphtha will deepen, making it mathematically impossible for Chairman Kevin Warsh's Federal Reserve to justify a monetary easing cycle, and forcing corporate leaders to permanently accept that the era of secure, low-cost globalized commerce has officially been replaced by a balkanized trading order run on regional resilience.